Traders, welcome to Market Outlook, Trends, Risk Events, and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 to 40 minutes or so. It's an extremely busy week, of course, as you probably know. So we'll follow the usual format, though. So we'll just check out how markets are trading currently, just check out some of the themes, obviously tariffs front and center at the moment with the potential agreement with China and US, and then obviously the meetings of the two presidents on Thursday, and that has given a bullish feel to the to kick off the week, really. So we'll just check that out quickly. We'll then get into earnings, of course. 5 of the Mag 7 reporting this week. So we'll just give a quick preview of each of those 5 and look at the charts as well. We'll then quickly dive into last week's sort of main events. We had US CPI data, of course, UK CPI as well. And some PMI data. So very quickly look at that. Obviously implications for then this week. And the main event, of course, is the Fed meeting. So we'll preview that as well as several other central bank meetings this week. The Bank of Canada, the Bank of Japan, and the ECB meetings as well. So we'll look at all of those and look at the associated currencies and see what the charts are doing. So pretty busy webinar, pretty busy week ahead, as I say. Here we are with, what we hope to get through in the next 30, 40 minutes or so, as I say. If you do have any questions, please do ask them along the way. More than happy to try and answer whatever question, however big, small, whatever you're looking at or whatever we're talking about, then please do, ask any questions. We'll try and answer them. So markets generally at the moment, pretty buoyant, as I say. US and China reached that framework for basically President Trump and President Xi talks this week on Thursday. US tariff increase on China has been averted, and China was said to have agreed to a delay in a new rare earth exports licensing regime for a year. This is big news, of course, because that was what saw us sell off very sharply on that Friday. Rare earths, of course, being the main topic of conversation, no doubt. The view really here then is that the meeting between those two presidents on Thursday, that might see then a formal agreement in those areas. There's have been agreement on TikTok, soybean purchases, and then tariffs as well. And then potentially that essentially enacts a kind of further delay of those severe sort of 125, 145% plus really mutual tariff levels, which are threatened in April. That deadline was coming up. So this is big news, of course, and the risk rally continues this morning. Other tariff news, though, the US is to immediately raise tariffs on Canada by another 10%. And also President Trump, he's over in Asia, I think, at the Asian summit this week in South Korea. He said he won't meet Russian President Putin until he thinks they have a peace plan. European equities, though, firmly higher, really, generally, although they are off their best levels. US equity futures are soaring to record levels again. Obviously, on this US-China trade commentary. FX-wise, we've got high beta FX, so Aussie dollar, Kiwi dollar, boosted really by, of course, the US Sino optimism, really. And the loonie, actually, as well, the Canadian dollar is looking slightly through US tariffs, underperforming the Kiwi and the Aussie, but still dollar CAD, modestly down, actually. Bond markets, they have been knocked by the risk tone, so US Treasuries, German bunds, although OATs do outperform, actually, as Moody's maintained France's rating, though it did revise the outlook to negative from stable. Gold, interestingly, that's taking a dive down over 2% now, very close now to the 4,000 level. Silver as well down. With that positive US-China optimism, obviously weighing on precious metals, really, although copper is near its all-time highs. Just checking crude, actually, oil that was initially boosted by the risk tone, but has since slipped a little bit into the red. Stock markets generally, if we just go to earnings, first of all, that's the chart that we put up the start of earnings season. That's moved slightly, I think, and with the positive earnings that we're seeing, really, and revisions as well. Aside from that, we do get obviously those 5 Mag 7 earnings reports, just generally on the markets. Markets hit all-time highs, of course, Friday. We're probably likely, we're going to get those today again on Monday to kick off this week. We did have that CPI data, delayed CPI data last Friday. That showed 3% in September, and we'll look into that in more detail shortly. But it didn't really stop any, fueled near certainty of a Fed rate cut, of course, on Wednesday. IBM and AMD rallied after Reuters revealed AMD chips are powering IBM's quantum error correction breakthroughs, actually sending chip stocks and the NASDAQ soaring. Intel faded despite a profit beat. That was up over 7% at one point, I think, but faded quite dramatically, while Coinbase actually surged over 7% on news of a national bank charter filing and bullish Fed commentary on crypto master accounts. The shutdown obviously continues, but traders did really cheer the CPI relief, really, quantum optimism, and then that pro-crypto regulatory shift. Generally, last week's narratives probably characterized by Goldilocks at the start and then risk on towards the back end. Here is then the Mag 7, if we get to these first of all, or 5 of the Mag 7, I should say, but this is a chart with the Mag 7 generally outperforming the rest of the market that you can see there, around 18.5% up on the year, as opposed to the S&P up just over 13.5% on the year. If we look into then, if we look into results then due this week, first up, Microsoft. I'm just checking the days because they're Wednesday and Thursday after the US close. Microsoft, is after the US close on Wednesday. Also Alphabet, also Meta after the US close on Wednesday. And then we have Apple and Amazon after the US close on Thursday. So if we get to, first of all, look at Microsoft, I'm just going to grab the chart 1 second. Just bear with me. So here's the Microsoft chart. First of all, let's take off a couple of lines here and bear with me 1 second. Not sure. We've got some old fib levels here. You can see how old they are. Just bear with me 1 second. Right. So, Microsoft charts, their earnings due after the close on Wednesday, as I said, just below all-time highs. That you can see that spike high at the end of July, that high at $555. We're now currently $523. Pretty solid performance this year by Microsoft, rallying around 20%, so outperforming the S&P, as I said, up 13.6%, and also outperforming the IT sector overall. Has given back a little bit of gains, or had done until last week, really, and we're just edging higher again. Just for you guys, Microsoft, the second biggest stock by weight in both the S&P and the NASDAQ, makes up around nearly 12% in the NASDAQ, and is also the second largest constituent in the Dow. Options prices, they imply a move of plus or minus 4.4% in the 24 hours following the report. Consensus estimates, they expect EPS at around $3.68 on revenues of $75.4 billion. Microsoft, for your guide, has ended in the green following the last 2 quarterly reports. Just technically, really, that's a very quick guide, really, just on a couple of numbers and where it is really compared to others in the market or the broader market anyway. Yeah, you can, as I said, all-time highs at $555. You've got that swing high at 531. Then the blue lines are the 50-day moving average at 511, and below that is the 100-day moving average at 506, which tallies with these sort of this sort of area of support around 508. So that would be Microsoft. Looking at then Google, so Alphabet, which made all-time highs on Friday. That you can see that all-time high at 262, and we just closed just off that at 260. Nice break actually from this consolidation from before. Alphabet actually being the second best performer in the Mag 7, only outdone actually by Nvidia, up around 28% year to date, easily outperforming then the S&P 500, of course. Occupies a weight of about 6% in the S&P when you combine both share classes, and around 9% in the NASDAQ. Options prices for your guide, they anticipate a move of around plus or minus 6.1% in the day after the 24 hours after the upcoming report. So technically, yeah, a nice break higher up to those record highs then. And really, you've got probably support around the previous record high at 256. And then you can see the blue line, the 50-day moving average, well below, which tallies with that swing low from October, around 237. So that's Alphabet. Meta, just for your guide. That's moved higher by around 22%. I think this year sort of matches the performance of the communication services sector, although outperforming, of course, the benchmark, the S&P 500. Ratings wise, Meta remains about the fifth largest stock in the S&P 500, and the NASDAQ weights of around 3% and 5.5%. Options, they see a bigger move, actually plus or minus 6.4% on the day following the report, with the stock actually having gained ground following the last three earnings releases in a row. For your guide, EPS, well, consensus estimates $6.73, and that would be on quarterly revenues of $49.5 billion. So interesting. Yeah, we're just hanging around the 50-day moving average and supported by the 100-day moving average. Those are at the 50-day at 743 and the 100-day at 732. Just looks like bullish consolidation before a break higher. And then you've got the all-time highs from mid-August at 795 spot 46. You've got that swing high from mid-September as well, just below that 790.80. So that's pretty strong resistance. And then you've got the swing low from earlier in the month, actually around 690 as a guide if we do move lower. So that's Meta. Then Amazon, just pull up the chart. Trade's pretty much flat year to date. If we just pull it back a touch, yeah, you can see we started. Where did we open up? Opened up to all the twos, 222, and we're just above that, 224.21. So disappointing from Amazon, really flat, really pretty much year to date. So underperforming its Mag 7 peers, definitely, and also then the broader S&P 500. It still remains an index heavyweight, of course, accounts for around 4% of the S&P 500, around 7% of the NASDAQ. And it's also a Dow component. Options markets, they see a move of plus or minus 6% over the 24 hours after the release. But the stock has lost ground following the last three straight quarterly updates, despite having beaten consensus EPS expectations in every quarter since Q4 2022. Expectations this time, EPS $1.57. Or ex-Rivian $1.55, and that's on quarterly revenues of 177.7 billion. So interesting, really. Point four, Amazon really underperforming the Mag 7, as I've said, and also the broader market. You've got these highs from back in February at 242.52, and then probably the swing low from this month, low at 211, which corresponds with the low from August as well at 211. So that should be strong support. Interesting chart really for Amazon, which is midpoint of those highs actually, and those that quite strong support that we just pointed out. Finally, Apple, pretty strong on the chart that you can see if we just pull it back. That previous high from December, is at 260.10, and we're just above that now with the all-time high at 265.29. 50-day moving average below here, well below at 244. Obviously, the iPhone 17 launch has been well received, although there is a lack of progress really on the AI front, which sort of helps explain why the stock, trades year to date just modestly higher actually, and has been sat in the red actually for most of the year, of course. Still the third largest stock by weight in the S&P and the NASDAQ, also a Dow component. And options imply a move of around 3.5% in the 24 hours after the release of earnings. Consensus expects diluted EPS of $1.76. That's on revenues of 101.7 billion. So those are all the 5 of the Mag 7. We do get around a third of the S&P 500 companies reporting, around 187 companies reporting this week. So do look out for others. On our list, we have Eli Lilly. They're out on Thursday. United Health out on Friday, I believe. Caterpillar Wednesday, sort of bellwether for industrial stocks, and Boeing as well out on Wednesday. In amongst sort of Comcast, Verizon, Merck, Chevron, and Exxon, they report on Friday. So a lot of companies to look out for, as well as certainly the Mag 7. Okay, just moving on then from stocks then. Let's get quickly to last week's main data points. Of course, we had US CPI data out on Friday, the delayed data from October 15, I think it was. Softer than expected. So the headline rose 0.3% month on month, 3% year on year. And then that was headline actually. And then core was 0.2% month on month and 3%. Consensus was a 0.4% month on month headline and 0.3 core, so 1/10 lower on the month on the Fed to cut rates this week, even though the core month on month rate, and you can see on this is the blue bars, they continue to track above that black line, and the black line is the 0.17 month on month rate, which many economists believe we need to average to bring the annual rate of inflation down to the 2% target. So you can see only occasionally have we been below that 0.17 month on month core reading, which is what we need over a period of time to get to the 2% target. So we're still at 3% and still above the Fed's goal, if you like. In detail, a little bit more detail, core goods inflation, that was modest with weaker used car and medical prices. They were offset by small rises in new vehicles and clothing. Housing inflation was pretty benign actually, while airline fares and gasoline, they saw temporary spikes. Key though, of course, really I should mention tariffs and their effect still remain muted really, as firms have shifted supply chains towards lower tariff countries, reducing cost pressures, and then they've slowly, and if you read reports, slowly been lifting prices, and really these aren't really expected to feed in properly or totally until next year. Of course, though, some economists do think that even though we do get a small lift in prices, they're kind of seen as a one-off adjustment rather than a persistent inflation driver. So I've kind of given you the two sides there. And it'll be interesting, yeah, going forward, whether we don't see this tariff-induced price pressure coming through, or even that some other price pressures, like definitely housing, which is slowly moving lower, that will then offset any of the tariff price rises. Easing energy costs as well, slower housing rents, as I've said, and also, of course, a cooling jobs market that should reinforce disinflation through next year, really. And then it's just competing, of course, with any, as I said, tariff-induced price pressures. Yeah, all in all, though, green light for a rate cut, obviously, this week. So that's US CPI. We did get UK CPI as well last week, quite important for the Bank of England, of course. Inflation actually surprised quite significantly to the downside in the UK. So worth pointing this out. Headline came in at 3.8 versus consensus 4%. And core at 3.5% versus consensus 3.7%, while services they came in at 4.7% versus 4.9% expected. So momentum slowed across categories. Actually, in the print was also below the Bank of England's expectations from the latest monetary policy report, the MPR, in August, where it did have headline at 4%. So many hoping this is now the peak in inflation in the UK, and certainly following last week's downside surprise to wage growth as well, plus this lower than expected inflation, markets did shift really and increase their expectations for rate cuts from the Bank of England going forward. Around 9 basis points for the November meeting now. So around sort of 36% chance, 1 in 3 chance really that we'd get a 25 basis point cut at the November Bank of England meeting. And then there's a higher chance of then a December cut, with about 60 basis points now priced in for the coming 12 months. So interesting shift in dovish expectations really in the UK. Have to also would say account for some BOE worries on financial stability, actually, and leverage in some parts of the financial system, potentially playing out in the background, certainly. But lower inflation might be better news, actually, as well for the UK budget via interest rate payments, of course, inflation-linked interest rate payments and expenses. All in all, a dovish market reaction. And if we pull up the cable chart, actually, we can see how sterling did underperform last week. Just bear with me 1 second. So this is the cable chart, sterling against the dollar, of course, which is here. So you can just see we move lower really over a few consecutive days, actually. 6 days, I think. Yeah, so not a great week, although not major moves, but just move lower against the dollar. On cable, then you've got this swing low from mid-October at 132.48. And then you've got this fib level actually at 131.40. So that's major support you can see there, which is that swing low from the start of August. Otherwise, upside, if we can find some buyers and some support, then you've got the 50-day and 100-day moving average above the blue and grey lines at 134.53 and 134.75, in amongst, obviously, that minor fib level of this move higher at 133.86. So that's cable. Just briefly as well, we did have PMI data, which I need to just tell you about. I need to crack on, really. Yes, PMI data, that was the matrix that we showed you last week. And Eurozone is really the key one here, with the composite rising actually to 52.2 in the Eurozone, the highest level since May 2023, on the back of services strengthening, and actually manufacturing rose to 50.0 from 49.8, so above the 50 boom sort of contraction expansion line. Positive momentum really suggested by the data, particularly in Southern Europe, while France's weakness appear pretty idiosyncratic, really. All in all, decent numbers, although the euro area growth is expected to remain modest at around 0.2% Q on Q in Q4. But then this all helps the ECB meeting, which could be fairly quiet. And we'll get into that very shortly. So that was the PMI data last week. Okay, obviously, chock-a-block full of central bank meetings. So let's get on to the Fed first of all. Just for your guide as well, US data releases, they do remain scarce this week because of the US government's shutdown. I think there's around a 50-50 bet now that the shutdown lasts beyond the 16th of November. And it could be that the 15th of November becomes a key date with Scott Bessent, Treasury Secretary, stating that the US military does not get paid after this point should the shutdown remain in place. Probably means then we don't get Q3 GDP data this week or core PCE data, which is the Fed's favorite inflation gauge, was due for release on Friday, but probably means we don't get that. But for GDP, well, reasonably strong, of course, around 3% Q on Q expected. But just aside from that, then obviously the Fed meeting we get on Wednesday, first up, takes the spotlight, fully expected to cut rates by 25 basis points, nailed on by money markets. That would take the Fed funds rate down to 3.25% to 4%. And then another cut is expected in December, really as the Fed weighs this cooling sort of labor market against still sticky inflation that we've just talked about. Policymakers, they kind of remain divided actually between supporting jobs or keeping pressure on prices, while of course a delayed delayed government data really clouds the broader economic picture. If you think you're trying to make a rate decision with very little data at hand. There is also speculation that the Fed could end its balance sheet runoff early due to recent money market strains, though opinions differ on whether it will be a full stop or a gradual wind down. Mortgage-backed securities are expected to continue running off slowly, given housing conditions. So really, it's what Chair Powell signals after this rate cut, what he expects to happen in December. And then in January, as I said, December fully priced, and then around a 50-50 bet, I think, for another third rate cut. That would be a fourth in a row in January. Broadly, markets do expect easing in 2026 then, but the pace, as I said, kind of remains uncertain, really, and it'd be interesting how Chair Powell frames this, really. All eyes will be on his press conference, really. Any signals on how confident the Fed is that inflation is contained will be certainly pounced upon, and then how aggressive the rate cut path could become into next year. So really interesting meeting, really on the signals rather than obviously the decision, if you like, and then the press conference will have a lot of attention on it. Sorry, here is the chart that we just had up with obviously that elevated price pressures around 3%, with a target being 2%, of course, and rates around that, well, 4 to 4.25, and fully expected to come down to 3.75 to 4%. If we look at the DXY chart, then let me just pull it up. I always say this, but yeah, the euro has by far the biggest weighting in this index, around 56%. So just remember that. So if you flip this on its head, it would be the euro dollar chart, really mirroring it. So yeah, we've got resistance around these highs from earlier on in October, just above 99. And then we've got that swing high from sort of start of August, end of July, just above 100. So just a few obvious points of resistance, it looks like. And then support we've got at this swing low, and the 50-day and 100-day moving average is around 98.12, 98.10 or so. So pretty clear support and resistance near term, at least. And you've still got this long-term trend line, if you remember, from 2011 actually, then touched a point at 2021, and then we touched it as well a couple of times actually in June and then in September, and that would probably come up around 97.22 for your guide. So that's the Fed. Moving on to, we'll do it in date order. So Bank of Canada as well, we get on Wednesday before the Fed actually. Most in markets expect a 25 basis point cut, which would take rates to 2.25% now, though some economists do see a hold. The Bank of Canada, they recently abandoned their forward guidance, really shifting to shorter term data driven decision making. As for data and the sort of economic backdrop remains mixed. Job growth remains strong. Actually, inflation is elevated. And sentiment surveys actually highlight cost pressures still, but then obviously trade tensions have been front and center, certainly with the US stopping talks and raising tariffs by 10%, as I said at the top of the webinar. So trade tensions still very much evident. And they've weighed on confidence, of course, and really then pushed markets to fully price in a rate cut on Wednesday. We also get the monetary policy report. So that includes updates to inflation, growth, and the neutral rate estimates. Policy, though, is now below the midpoint of the Bank of Canada's neutral range. So really, again, it will be watching Governor Macklem's tone for any signs of whether this marks now the end of the easing cycle, or then if more cuts could follow as the bank really balances sort of persistent inflation with slowing trade and growth momentum. Dollar CAD has been struggling, although, and still remains in this upward channel. So that means dollar strengthening against the loonie. You can just see we are slightly lower on the day and potentially breaking this sort of near-term support around 139.79. Below that, we've got the 50-day at 138.92, but it still means we're in this sort of bullish, modestly bullish channel, you can see, with a series of sort of higher highs, higher lows. Bottom of that channel wouldn't come into around, if we extend this, when it taps, a couple of highs and a couple of lows. That's not down to around 138.50 or so. A touch higher than that for that bull channel. So we're very much still in that into the Bank of Canada and the Fed meeting, of course. Otherwise, Bank of Japan meeting, that's out on Thursday. If I just pull up a chart very quickly. Which has, of course, where rates are and where inflation is as well. Core inflation at 3.3 and super core, that is, and core otherwise at 2.7. Bank of Japan expected to keep rates unchanged at 0.5% this week. Kind of little urgency to tighten policy. Obviously, we've had major domestic news happen with the election of the first female prime minister, of course, Takaichi. Around a 10% chance of a rate hike. Has been, of course, a lot of speculation really in this build up to this meeting, really, over the last few weeks. So the Bank of Japan was edging closer to hiking, but policymakers generally have sounded fairly cautious amid, of course, global headwinds and then those recent political changes, as I said. The bank did surprise markets last month, announcing plans to gradually sell ETF and J-REIT holdings while maintaining rates by a 7-2 vote. Political shifts, of course, following Takaichi's leadership win have added uncertainty as well, although they're not expected really to alter monetary policy decisions for the very near present. An eventual 25 basis point hike is possible early next year, but the overall stance really remains accommodative, with no further hikes likely before really maybe through 2026 and beyond. There will be focus on the updated outlook report by the Bank of Japan, potentially modest downside risk to GDP and inflation forecasts. And really, it is, again, any hints about the timing of policy normalization that will be key, of course, especially as Japan faces slower growth and pressure from a stronger dollar and higher global yields. Near term as well, for the week as well, has been suggested President Trump could be meeting the new PM during his trip this week. So what does that mean for dollar yen? Well, the White House would, of course, like it lower to correct the US trade deficit with Japan, while Takaichi's presumed policies anyway are yen negative. She is known to be a dovish fiscal and monetary policy person. So yes, interesting with this meeting as well with Trump and Takaichi potentially this week, as well as then the Bank of Japan meeting. Yeah, so let's pull up the dollar yen chart. Which is here, and you can just see we're not far off those recent highs, and you can see the big move higher, gap higher actually after Takaichi won the LDP leadership vote, and obviously we had a bit of noise here around her struggling a little bit to find a coalition, but that she is now done with Ishin, and then we're back up to those recent highs. Just pull it back, you can just see then where we are, sort of 152.78, with the recent high being at 153.27. Interesting, really. Now, sort of flipped really with the with dollar yen, and it's sort of reasoning as to what's going to turn it lower, and really that's only if we get a broad-based dollar decline. Japanese policy makers really not going to intervene around here. You would think probably we'd need to get up to sort of 155, 160 for then alarm bells to be sounding. The Japanese last sold dollar yen near 160 in July 2024. Yeah, which you can see there, where we got up to 161.95 actually. So relatively, it's really all about the pace rather than the absolute level, but the pace of declines in the yen. But then obviously we may get some pressure from Donald Trump as well. So interesting point for dollar yen as we approach these recent highs and whether we push higher. We've got long-term fib levels in here, minor fib level at 154.81 if we do break this, and then obviously that peak from, well, the year-to-date peak actually at 158.87. Otherwise, support around the 151.61, which is the 61.8 of this move lower, and then the halfway point of this move is just above the 50-day moving average, so that's a 149.37. Okay, quickly then on to finally the ECB meeting, which is on Thursday. I'll pull up euro dollar. Let's just expand this. Yeah, okay, so I've got some short-term fib levels in there still. ECB meeting Thursday, yeah, nothing going to be market moving potentially. As much as I don't like to say that, widely expected to keep the depo rate at 2%, will keep its data-dependent stance, reaffirm its cautious approach, really, and no doubt use, or President Lagarde may use the policy being in a good place, which is probably what you've read already. Yeah, still cautious though. 2026 inflation forecast revised slightly lower to 1.7. That prompted a sort of mildly dovish market reaction. Lagarde, this was from the September meeting actually, later clarified that such small changes wouldn't trigger immediate action, noting economic risks are now more balanced. No real fresh data to change the picture then. So the ECB will stay patient until December when it gets its fresh economic staff projections. That could then reopen the debate, possibly on rate cuts in the new year. Markets don't see the first or the next rate cut until, actually early next year if growth remains subdued. We'll be looking on for any comments on, well, the transmission protection instrument, the TPI, amid, of course, recent French political instability, though that could be reserved really for the Q&A. But really, it's as steady as she goes, really sort of image really from the ECB expected, preferring pretty much flexibility as it assesses inflation trends, growth softness, of course, and broader market conditions before potentially shifting policy into easing territory later. Early next year potentially, but at the moment, nothing too much happening. Euro dollar, you've got the 50-day and 100-day just above current prices at 116.60 and 116.86. We're just sort of at the halfway point of this move higher. The August move up to the September highs at 119.18, and then near-term support probably at 115.92, which is the near-term 61.8 fib level of this move, this near-term move. If we put it back, you can just see 119.18 key level with then 117.17. If we get through the moving averages, that's the 38.2 of this short-term move through the summer, August and September. Okay, I am going to wrap it up there. Thank you so much for staying with us for 40 minutes. Obviously, a lot going on, and really interesting. I think that there's so much going on that markets will take time to digest. Really, the events sometimes is what happens with so much sort of expectation around these major risk events. So we'll see. Obviously, honing on Powell and any signals he gives about policy going forward will be key, with pretty much fully priced for December and a 50-50 bet for January. So quite a lot priced in for him to sort of validate, and that will be interesting whether he does confirm those expectations or not, of course. As well, Mag 7 earnings, as we said, so a lot to look forward to and a lot to review next week. So please do listen in same time next week, where we'll review everything that we've just previewed, of course, as well as looking ahead to, it will be non-farm payroll, actually, if we do get that data at all on the first Friday of the month, and we do get a Bank of England decision as well, rate decision next week, I think, on the Thursday. Let me just check that. Yes, we do. So, a lot going on. Do follow us on social media, and also we do put out a daily commentary as well. On the website after the US close. Really do appreciate you being on the call for such a long time, and please do tune in same time next week. Okay, take care, and we'll speak to you then.